This Week in Economics on the 11th of August 2000 from WBRN Radio and on the Bostonred Network. This particular episode is, as usual, a collaboration between WBRN Radio, the Bostonred Network, and Cranston Analytics, which we get our basic model here. We'll start out today a little bit dated here, but this is from the Federal Reserve Board of Governors. This is actually on the last day of July. We just need to sort of set a foundation up here, and at the end we will have the address by the head of the Federal Reserve, Jerome Powell, and talking about the same thing. This is the interest rate. It sets up a basis for what occurs in the U.S. as far as monetary policy is concerned. Now, then we'll address the recent problems, I suppose you'd say, with the tariffs. Now, the tariffs themselves are just that. That is between the U.S. and China, the administration imposing 10% more on 300 billion of Chinese product. Now, with the Chinese, their position is a very interesting position, where they are transforming their economy from one that is an export operation to one that is more self-contained, that is based upon buying within China. Effectively the same transition that happened in the U.S. when the U.S. transitioned from manufacturing. Some of that has attempts to reverse that by the present administration. But however, an economy that is service-based is more of a modern type economy. Manufacturing primarily is done in other countries. There's some manufacturing there, but what the Chinese are doing is moving there to a more of a consumer-based economy. They can do that. They have 1.2 billion people, and then an extensive network of economic partners across the world in various emerging nations, and also the changes that are occurring. Now, we'll touch a little bit on some of the things that are happening in the U.S. I guess we'll just do it now. The recent redundancies of layoffs of 400 workers at the Wells Fargo banking enterprise. You're going to see more of these. Incidentally, these workers are in more or less in customer services. The very large redundancies that occurred at Deutsche Bank and various other banking enterprises, and this is tied to a number of the central banks lowering their interest rates. That translates into banks making less money off of the products, they now call them products, that they offer. So this has an enormous effect there, and this is the flip side of cutting interest rates. How much cutting do you do? The administration would like to cut interest rates more. Now that is towards a more accommodationist type of structure. During the Depression, the aftermath of the Depression that began in 2008, 2009, when the former President Barack Obama took office, conservatives criticized the Fed for cutting interest rates. Well, that was necessary. That's standard economic policy from any textbook, Keynesian textbook. It happened during the Depression, and it happened at that particular time, and also quantitative easing there, where the Fed was actually buying securities. Now they're unwinding these securities. But back to the flip side of this cutting, you run the risks of moving more and more into negative interest rates. Now, as you do that, your ability to cut interest rates disappears, period. So the central banks can do very, very little. All of this points to a new dynamic for industrial capitalism in the so-called industrialized nations, that it is no longer working. The performance is very low. We'll look at what's happening in the UK. Now, in the UK, much of that is to production, but at the same time to Brexit. Brexit is a very, very difficult situation. It's a political situation there, and the new Prime Minister Johnson is pledged to leave the EU at the end of October. And we're in August now, so then September, October, with or without a deal, and we'll address some of that in this broadcast. And once again, the Brexit for Europe is much more important and potentially devastating than the trade. Now, the tariffs with the trade. Now, that what happens is there was some possibility of a deal being made. It's like we're on a quiz show of some kind, but let's make a deal. But the problem is with let's make a deal is there can't be a deal when you are exacerbating the situation you would normally be negotiating on, such as the designation of China as a quote-unquote currency manipulator. The Chinese currency, the yuan, renminbi, whatever we want to call it, is basically now at 7 point not, I believe, point 3 or 4. It moves up and down. I didn't mean to say manipulates up and down, based upon the current situation. Now at 7, that is pretty standard. That is the peg, 7 to $1. Any rising above that number would make Chinese products cheaper, period. But the Chinese, their position is this is a market type of situation. There is that the Chinese government keeping Chinese industry competitive. And we'll see more of this as central banks maneuver. Let's go to the Federal Reserve statement here, and we'll just read part of it. This is from the Board of Governors on the 31st of July. But it is very relevant here. Information received since the Open Market Committee met in June indicates that the labor market remains strong and the economic activity has been rising at a moderate rate. Job gains have been solid on the average in recent months. The unemployment rate remains low, although growth in household spending has picked up from early in the year. Growth of business fixed investment has been soft on a 12-month basis. Overall inflation and the inflation for items other than food and energy are running below 2%. The market-based measurements of inflation compensation remain low. Survey-based measures of longer-term inflation expectations are little changed. Consistent with the statutory mandate, the committee seeks to foster maximum employment and price stability in light of the implication of global developments for economic outlook as well as mute inflation pressures. The committee decided to lower the target range of federal funds to 2 to 2.14. That's 2.25. This action supports the committee's view that sustained expansion of economic activity, strong labor market, and inflation near the committee's symmetric 2% objective are the most likely outcomes, but uncertainty about the outlook remains as the committee contemplates a future path of the target range for federal funds rate. It will continue to monitor the implications of incoming information for economic outlook and will act appropriate to sustain the expansion with strong labor market and inflation near its symmetric 2% objective. In determining the timing and the size of future adjustments to the target range for federal funds rate, the committee will assess realized and expected economic conditions relative to its maximum employment objectives and its symmetric 2% inflation objective. This assessment will take into account a wide range of information, including measure of labor market conditions, indicators of inflation pressure and inflation expectations, and reading on financial and international developments. The committee will conclude the reduction of its aggregate security holdings in the system's open market account in August, 2 months earlier than previously indicated. Voting for this was Powell, Williams, Bowman, Bullard, Evans, Coyles. Voting against Esther, George, and Eric Rosengere. He's from Boston, who prepared that this committee maintain the range for the federal fund rates from 1.4 to 1.5, no, to 1.50 there. And this is a very interesting. Esther George at one time was talking about cutting rates. Rosengere had been out of it there, but anyway, they're in it, and this is where they are standing here with the Fed. Very interesting situation. In other words, everything is basically in a non-economic sense up in the air. And I'd hope to have this, I don't have it now, but a statement of former Fed chairs. This is from CNBC, and actually the statement was posted in the Wall Street Journal. These are 5 Fed chairs here, and the key points: we unite in conviction that the Fed and its chair must be permitted to act independently and in the best interest of the economy, free of short-term political pressures, in particular without the threat of removal or demotion of Fed leaders for political reasons. Stated commentary: the former leaders of the Fed emphasize that the Fed's powers are appropriately checked by Congress. The president has repeatedly lashed out at the U.S. Central Bank and its chair, Jerome Powell, which he appointed, claiming raising interest rates are putting a brake on the economy. And picture there, Chair Yellen, Dr. Yellen, Ben Bernanke, and Paul Volcker. Previous heads of the Federal Reserve called for an independent central bank in face of repeated attacks by DJ Trump in an extraordinary joint commentary. We unite in conviction that the Fed and its chair must be permitted to act independently in the best interest of the economy, free of short-term political pressure, and in particular without the threat of removal and demotion of Fed leaders. And of course that was signed by Paul Volcker, Alan Greenspan, Ben Bernanke, and Dr. Janet Yellen. They emphasized the Fed power, and in the short-term moves called by politicians, especially around election, have led to economic calamities. Monetary policy based on the political rather than the economic needs of the moment lead to worse economic performances in the long run, including higher inflation and slower growth. It is critical to preserve the Fed's ability to make decisions based upon the best interests of the nation, not a small group of politicians, the piece went on. The president has particularly lashed out at the central bank and its chair, Mr. Powell, claiming rising interest rates are putting brakes on the economy. That is false. He claims the Fed made a big mistake in hiking rates in December and even considered demoting Powell. The central bank raised interest rates 4 times in 2018. The Fed cut rates for the first time in now this is interesting here, more than a decade in July. That is more than 10 years, 2 days ahead of the policy decision. The administration took to Twitter advocating for a larger reduction in borrowing costs, saying a small rate cut would not be enough, after characterizing Chairman Powell's rate as a mid-cycle adjustment. In a tweet, Powell let us down by not clearly signaling more rate cuts. Well, they're not in there. And anyway, Powell has refused to comment publicly on DJ Trump's criticism, repeatedly emphasized the independence of the Fed. The chief recently said the central bank would never move interest rates because of political factors are to provide its independence. Anyway, this is a very dangerous precedent. It's not without a history. Presidents have argued with the Fed from time to time. President Reagan, in particular, President Johnson, back to President Johnson, different economic time there on interest rates. However, there's a different situation today. The old standard, well, if you raise interest rates, you stop the economy. But the economy, and in particular the global economy, has never been in a situation where some of these central banks are going into negative interest rates to try to keep an economy afloat. Now, that happened in Japan. 10 years of negative interest rates there caused the economy just basically to be in a state of animation, basically, for 10 years. And then you basically have no economic activity. And that is the problem there when you have an economy that is based 70-80% on consumers. If deflation has products cheaper, consumers will buy, but consumers at the same time have less buying power. So in other words, it is a double situation there, and you don't really want to get into that if you are ahead of the curve. And let me see if I can get this one last piece up here. This is from the NPR. If our economy is so great, why did the Fed vote to juice it? Now, that is an interesting situation. It is juicing. Last week, policymakers at the Fed voted to bring interest rates down if despite a decade of economic growth, record low employment, solid corporate profits, and a good market. It is despite the fact that the federal government has already been juicing the economy with big spending and cuts. In the old days, the Fed would be worried this would all make the price of everything explode, inflation, and it would be voting to increase rates to slow things down. The governors are putting their foot on the accelerator, and you'll hear from Chairman Powell explain that inflation, weak growth, trade policy uncertain, and muted inflation there, and the decision has gotten a lot of attention, including the indicator throttle down episode. We have been wondering maybe the correct reaction should be. Former Fed Chair Dr. Bernanke, shortly after leaving the helm, wrote that he was pretty exasperated by the general public's failure to grasp just how limited the Fed power is. He wrote, if you ask the person on the street why are interest rates so low, he or she would likely answer the Fed is keeping them low. That is true only in a very narrow sense. Translation, we are not superheroes here. We know we don't have the power of the economy that you think we do. The main way the Fed influences interest rates is very narrow, usually through a policy lever known as the federal fund rate. It is the rate banks charge each other to borrow money overnight, and by making it cheaper for banks to borrow, it makes it cheaper for businesses, households to borrow. That is a traditional way the Fed has tried to boost the economy. Classic Keynesian economics there. It injects more money into the system. The federal fund rate is an important interest rate and influences other interest rates, mortgages, business loans, credit cards, etc. in the short term, but federal power interest rates are generally very limited, and the market ultimately determines real interest rates, not the Fed. An important high note there. And to understand why interest rates are so low, it's helpful to think like a central banker. When they make their decision, they have a theoretical interest rate in mind, in typically central banker fashion. It's a bunch of confusing names that make your eyes glaze over. The equilibrium real interest rate and the Wexelian interest rate and R star, the natural rate of interest. There's also a natural rate of employment. Central bankers like Powell have been increasingly calling it the neutral rate, so we'll go with that. The neutral rate is a theoretical resting place for interest rates, and the Fed doesn't control it. Putting a number on it is a guess or a moving target. It's based on the interest rate in the economy's sweet spot. It is where the cost of borrowing money makes everything hum nicely. Basically, everyone is employed if they want to be. All the factors, machines, and technology are put to use, and the price of everything is pretty stable. Not a lot of inflation, not too hot, not too cold. It is a natural, neutral place to be. The theoretical rate, like the real-world interest rate it represents, is ultimately set by markets for money coming together. On one side is all the savings, our bank accounts, pension accounts, and so forth. That is the supply of money for stuff, supply of capital, that grows in our economy. On the other side of that stuff, AKI investments of factories, houses, laboratories, rocket ships, and office chairs. That's the demand for money, because it is a gazillion of buyers and sellers are all coming together to agree upon the price of borrowing. The issues the Fed and all of us realize has been facing the neutral rate has been falling and falling and falling since before the Depression. That's why the Fed finds itself having to lower the rate under its influence now. Even this far is an economic expansion. The fact that the neutral rate is so low is a reflection of a fundamental economic issue. There's a big supply of savings floating out there, but there's nowhere near demand for investment, and the lack of investment is bad news for economic growth. What is investment? The administration, according to this, sold the Tax Cut and Jobs Act as a solution to the problem of lackluster investment. In a newsletter, Kevin Hassett, who was then one of Trump's chief economic advisors, argued that the cutting the tax rate on corporations would result. This is an old scheme here, investment boom, but as the Fed acknowledged in its statement justifying its action last week, the growth of investment over the past year has been soft, almost non-existent. Investment is a big deal because it gives us more machines, more tools, more structures that make workers better at their jobs. Well, we're getting that. And it is a key to better wage growth, economic growth, and ultimately improving standards of living. It's possible investment doesn't look great because the escalating trade war is scaring business away from investing, but the problem of lackluster investment and productivity growth has been with us for decades. This is a point we made coming in. The Fed has proven that no matter how cheap it makes it to borrow money, investment and productivity remain disappointing. The economy may look good on some levels, but it's still missing key ingredients. The Fed can grease the wheels of the economy with cheap credit, and it can help guide it in a better direction, but it can't fix the engine. So when the Fed cuts the funds rate by a tiny amount, that's why our reaction was basically, it's not going to fundamentally fix the intractable problems like low investment and productivity growth. Fall in neutral rate's a big idea, especially when it's because with rates so low, the Fed currently might not have enough room to cut. When the next economic crisis comes, our word, they say recession. So why, after a decade of economic growth with deficit spending and corporate tax cuts, with the Fed keeping its foot on the accelerator, we're not seeing a more growth? Well, very good reason there. You're not seeing a more growth because of the conditions of modern industrial capitalism. Let's get to some of the PCIs. These are from the market people. ISH market. This is the U.S. manufacturing PMI. Falls as lowest since September of 2009, the Depression. And fractional, this is the key findings. Outgrowth and muted demand hold back overall expansion. Employment falls for the first time since June of 2013, output expectations moderates to a series low. U.S. manufacturing firms signaled only a fractional improvement in business conditions. That's in July, with the headline PMI dropping to its lowest since the depression. That's in September of 2009. Driving less robust overall growth was a slow increase in production, muted client demand. Although the rate of expansion in new business quickened, it remains historically subdued, with export orders contracting for the second time in the last 3 months. In line with less robust demand, optimism amongst manufacturers dipped to a series low. Firms are more cautious towards hiring, with employment falling for the first time since mid-2013. Meanwhile, firms raising their factory gate charges at an increased rate, despite the input cost inflation sliding to its lowest in 2 years. Seasonally adjusted final market manufacturing PMI was posted at 50.4 in July, brought in line with the 50.6 in June. The latest reading signaled a fractional improvement in the health of manufacturing sector, but also indicated slower overall expansion since 2009. Manufacturers report only marginal rise in production during July, with the rate of growth erasing the slowest since June 2016. Sustained slowdown was linked by the panelists to soft demand conditions compared to early 2019. The role of new business remains muted. And let me just get the rest of it. Demand for domestic and foreign clients that were attributed to issues in the automotive sector, ongoing impact of tariffs there, and the hastency in placing orders. Decrease in new export business was second. Their muted client demand was reportedly a driving force behind subdued business conditions in July. Output expectations slipped further in a series of low since July of 2012, as business conditions are predicted to remain challenged over the next 12 months, especially for small firms. A reduction in the level of positive sentiment towards the year ahead was reflected in the first fall in employment since 2013. Number of firms registered as stable workforces during July, with difficulty finding replacement staff on overall workforce numbers. At the same time, backlog of work reduced at a modest pace. On the price front, firms signal at the slowest rate of input cost inflation for just over 2 years. Needlessly, firms continue to increase factory gate charges, with output prices rising at a solid rate. Finally, the purchasing activity fell for the first time since May of 2016. Comments from Dr. Williamson here. U.S. manufacturing has entered into its sharpest downturn since 2009, suggesting that goods producing a sector is on course to act as a significant drag on the economy in Q3. The deterioration in the survey's output index is indicative of manufacturing production declining at an amortized rate in excess of 3%. Falling business spending at home and declining exports are the main driver for the downturn, with firms also cutting back on input buying as outlook grows gloomy. U.S. manufacturing expectation of output in the year ahead has sunk to its lowest since comparable data were first available in 2012. We were focused on the detrimental impact of accelerated trade wars, fears of slow economic growth, and rising geopolitical worries. Employment now is also falling for the second time in almost 10 years as factories pull back on hiring amidst growth uncertainty. More positive new order influx picked up for the second consecutive month, although remaining worryingly subdued compared to growth before, with hopes production could tick higher in August. That normally does not happen. That is from Dr. Williamson. Let's move on here with these PCIs. More towards the emerging markets here. This is the Bank of Stanbic IBTC Bank of Nigeria. Improved demand and supports faster rise in new orders for 3 months. Key findings: new orders growth quickened. Further increase in employment and purchasing rate of inflation remains muted. Strong inflows of new business fed through to continued growth of business activity, employment, and purchasing in Nigeria's private sector in July as overall business conditions improved at a marketplace. Meanwhile, inflationary pressures remain relatively muted despite input costs, output costs rising at a slightly faster rate than in June. The headline figure there is the Purchasing Manager Index, PMI, reading above 50 is an improvement there. The headline PMI in July was 54.6, fractionally from 54.8 in June, but still signaling the market's monthly improvement in business conditions across the Nigerian private sector, although weaker than seen through much of 2018. The latest strengthening of operating conditions was still greater than the average since the survey started in 2014. Improved customer demand was widely mentioned by panelists at the start of Q3 of the year. New business increased sharply with the rate of growth quickening over the second month running, and output also rose at a marked pace, one that was softer than in June and one of the softest in 2 years. The strip of new order growth impaired some pressure on companies operating in July as a result of back orders. Let me just get the rest of this. Work increased for the third consecutive month. Rates of accommodation in outstanding business was only slight. However, firms expanded both in their staffing levels and purchase activity in line with higher workloads. Employment rose for the 27th consecutive month, although the rate of job creation remained modest. It was the fastest since April. Purchasing activity expanded at a sharper pace again in July. Higher input buying fed through a steep accumulation of stock inputs, and moreover the pace of inventories increased was the fastest since January. Overall input prices rose at the sharpest pace in year-to-year date, but the rate of inflation remains relatively modest. Slightly faster improvements in both purchase price and staff costs were reported. The rate of output inflation also ticked up in July. Business expansion plans supported continual optimism there. And this is an economist at at Stanbic Bank. Business activity in Nigeria's private sector moderated in July as output sub-index declined to 56.2 in July from 59.7 record in June, although there was a slight rise in new orders during the period. Consequently, Stanbic Nigeria's whole economy PCMI declined marginally to 54.6 during the same period from 54.8. This is still below the average PMI series in the past 30 months of 55.2. There is no immediate evidence to suggest that the economy and business activity in the country will pick up significantly or rise to a much faster pace to perhaps a peak of 59.1 that was recorded in May of 2018. On a somewhat positive note, inflation pressures have been muted for 3 months. We believe businesses are still mired with infrastructure challenges and operational bottlenecks that pertain to doing business in Nigeria. Hence the reason for moderate view on PMI growth dynamics, at least over the next 6 months. And we leave Nigeria and roll on here. Where do we go next? We'll find out in just a second here. Ghana, the PMI there, that's the ISH market PMI, Employment growth grows at a 6-month high. And solid increase in staffing levels, sharp rise in output. And in new orders, inflationary pressures muted. Basic conditions in the Ghanaian private sector continue to improve in July, with growth slowing signs of pickup at the start of Q3. Rising workloads, positive expectations for the future in both staffing and purchasing activities. The headline adjusted PMI posted at 51.2 in July, above the 50 no change mark for the 10th consecutive month, signaling a modest improvement in the health of Ghana's private sector. Although remaining modest in July, the rate of expansion in business activity quickened to a 4-month high. Output now risen in 9 consecutive months, similar to the pattern for output in growth in new business picked up in July, but remains modest. Rising new orders also contributed to an increase in backlog work, with demand in the delivery of finished product to clients also mentioned. Outstanding business rose slightly at a broadly similar pace to June. Efforts to keep atop of rising workloads encourage companies to increase staffing. Recorded for the 35th month running, the pace of expansion quickened to a solid pace that was the fastest since January. Purchasing activity was also increased, with the rate of growth accelerated for the 3rd consecutive month. Higher input buying supported a rise in stocks of purchases, following a slight fall in June. Another marginal improvement in supply delivery was registered in July, amid some reports that vendors had responded well to faster deliveries. On the other hand, material shortages reported led to delay in some instances there. Inflationary pressures remained muted in July, despite picking up slightly from previous months, but both purchase prices and staff costs rose at marginally quicker rates than in June. Meanwhile, input prices increased at one of the weakest rates in 15 months. Hopes on currency stability and improved economic conditions supported optimism amongst countries in Ghana. But business activity increased over the next 12 months. Sentiment was higher than in June, and with around 64%. The conclusion here from Andrew Hacker, Associate Director at IHS Market. While the growth of output and new orders picked up in July, rates of expansion remain modest as firms await a firmer improvement in demand. There are some signs that the confidence is strengthening in this regard, leading to fast increases in staffing and purchasing activity. That's Ghana. And we'll conclude this at this point. Let's see who is up next. Zambia, their PMI there, again from Stanbic Bank, output decreased at the sharpest pace in 9 months. That's a key finding there. Currency weakens, leading to price rises. Employment falls for the 4th consecutive month. Business conditions continue to deteriorate in Zambia in July, with private sector moving deeper in contraction territory during the month. Sharp and acceleration of decline is seen in both output and new orders. Weakness of the Zambian Kwacha, I hope I'm pronouncing that correctly, again impacted the economy at the start of Q3. The headline figure for the survey there, reading above 50 is an improvement, while showing a 50 anyway. The headline PMI dropped to 44.4 in July from 46.6 in June. The reading was below 50. No change there. Companies in Zambia continue to report a lack of money in the economy in July. Impact on customer numbers and contributed to steep reduction in new business. The rate of decline in output acceleration, the fastest since October 2018. Finding new work fed through a 13 consecutive reduction in backlog. That said, the latest decrease was only slight and the weakest for the year. Relatively weak fall in outstanding business partially reflected a scale back of the workforce numbers in July. Employment decreased for the fourth month running and to a great extent. But in June, purchasing activity also declined at a solid pace as companies were reluctant to hold excessive stock. No doubt about that. Purchasing prices continued to rise sharply in July, the third consecutive month in which the pace of inflation has been elevated. The passing on of higher input costs to consumers resulted in a sharp increase in output prices, although the rate of inflation softened from June's 43-month high. Hopes that the economic conditions will recover over the coming year support optimism amongst countries. More than half of all respondents predicted a rise in output. And not much here. Vic Cheshezi, he's the head at Stanbic Bank there. Current economic conditions should be helped by push-through effects of a reverse of the Croatia weakness experienced, and that is KWACHA. Anyway, that is where some of the emerging markets are. And, well, that we watch very, very closely to see where we are going there. And if there's any effect pricing due to tariffs. The tariffs were not the problem there. It was a weakening of the currency in Zambia, but also positive effects from other operators. So we see some things are much more clear, some things are not. This is kind of the way we sort of move around here. And that, let me see if I can get to the BBC, and this is the BBC news here from the other side of the pond, so to speak. UK economy shrinks for the first time since 2012. This is global conditions here. The Chancellor has told the BBC that he doesn't expect the UK economy to slide into recession after data showed it shrunk by 0.2 between April and June. Sadiq Javad was, I hope I pronounced it, was speaking after the Office of National Statistics said the economy had contracted for the first time. The surprise decline came after the Brexit stockpiles were unwinding and the car industry implemented shutdowns. The pound shrunk as data was released, fears of recession against the dollar. Sterling fell to 1.2025 against the euro. It dropped throughout the day to 1.0736 level, not seen since the global financial crisis, since the depression. This does not bode well. Robin Kent-Smith, head of GDP at said manufacturing output fell and construction sector weakened. That's the Office of National Statistics. The Bank of England cut its growth forecast. Recession occurs when the economy contracts, and this is a standard definition. They have 2 quarters. This is the first quarter since the fourth quarter 2012. Economists have not been forecasting a contraction in the economy's second quarter, but expect it to stagnate with consensus growth of 0. Why is the economy shrinking? This is from the BBC. Has shrunk to 0.5% growth in the first quarter, Q1, after manufacturing stockpiles ahead of Brexit helped to boost output when the manufacturing sector recorded its biggest quarterly rise since the 80s. The national office said GNP has been particularly volatile so far this year because of those activities. GDP growth fell to 0.2% there, and it shows negative 0.2%. This is the national. What the Chancellor is saying, Chancellor not saying much. The bank earlier this month said expect the economy to grow at 1.3 this year, down from a previous projection of 1.5. Asked about the impact of Brexit, we saw significant stockpiles, and this is what happened for fears that they'll not be able to get these. Other major economies are performing in Q2. There in Spain, they're at 5/10. In France, at just 2/10. Italy, nothing, 0. And in Germany, a negative 0.1%. The UK at a negative 0.2% there. But fundamentally, the British economy fundamentals are strong. Wages are growing. Employment is at record high. We forecast to grow faster than Germany, Italy, and Japan. But John McDonnell, the Shadow Chancellor, said the dismal economic figures are a result of incompetence by the Tory government. Pursuing a no-deal of Brexit is a political choice without a mandate there. And again, this is the CBI, the Employees Business Body, said the contraction was concerning for them. And the Federation of Small Business, which is calling for the emergency budget, said if the Treasury delays action until the 31st of July, the date for Brexit, the effects are likely to prove too little, too late. And from Dr. Williamson here, again, he's a chief economist at ISH Market, said the data shows that the economy is in decline and skirting with a recession as headwinds from slower global growth were accelerated by Brexit-related paralysis. Garfield Jung of the UBS Wealth Management said that while the global picture was becoming more gloomy, anyone looking for positive signs from the economy could look to robust private consumption reflected in a healthy labor economy. Household spending rose 0.5 in the quarter. That's from Samuel Toombs. He's the chief UK economist at Paphion. Macroeconomics agrees that household spending was still growing at a robust rate and said it's not time to panic. Wish I was optimistic as he is. The pound, which is at a 2-year low following the Brexit uncertainty, fell after the data was released. The currency also fell if there are expectations that the interest rate will be cut. Mr. Toombs said the market now sees a 70% chance of a interest rate cut in January, when Mark Carney is due to leave the Bank of England. He's escaping as he can. Let's look at the National Office of Statistics here. Welcome to their employment rate. This is age 16 to 64 seasonally adjusted at 74% there. Employment rate of age 16 and over seasonally adjusted is at 3.8. Domestic product for the quarter, with GDP in the UK negative 0.2. And the midterm mid-year population estimate is 66,435,600. So that's the UK's population there. And these are some just basic statistics. Let's do the market here. This is over the weekend. We don't say the accuracy, but we are looking at it. And of course, again, the FTSE 100 is down a negative 4.4% there. The change was 3.5. In Amsterdam, they were down 1.21% are there. And let's see, we go to Paris. They were down 1.11% there. All these are negative. The DAC in Germany was down 1.28% there. And the change was a negative 51.61. The Euro stock 50 was down 1.23%, or a negative, the change in negative 41.64. In Madrid, they were down 1.25%. There, the Dow was down 0.34% there, and the Nasdaq was down 1% in New York. The change there was a negative 80.02, and with the Dow a negative 90.75. The S&P 500 was down 0.66% there. In Bombay, they were at in the positive at 0.68%. The Hang Seng was down negative 0.62%, a change of 181.47 in the negative. And in the Nikkei was at 0.44, a change of 91.47. We already talked about the currencies here. Brent crude was up 2% at $58 and futures, that is, and 53 cents. That was a change of $1.15. West Texas crude was up $3.73%, and at $54.50. That's a change of $1.96. T-Boone Pickens is jumping for joy there. And the Forex at $1,497.40. And that ends our numbers there, and it will end us for this week in economics on the 11th of August. Numbers man here in the Jerry Pippin broadcast booth. Very interesting situation there. And we'll have some of Chairman Jerome Powell's address and a little bit of Q&A, hopefully, also. For those in business, make next week a productive one. And the consumer, obviously, keeping an eye on the prize, providing you can get out and get school supplies, as what happened, unfortunately, in El Paso, Texas. And we remember those people that died needlessly in El Paso, in the U.S., and in Dayton, Ohio.
Good afternoon and welcome. We decided today to lower the target for the federal funds rate by 0.25 percentage point to a range of 2% to 2.25%. The outlook for the U.S. economy remains favorable, and this action is designed to support that outlook. It is intended to ensure against downside risks from weak global growth and trade policy uncertainty, to help offset the effects these factors are currently having on the economy, and to promote a faster return of inflation to our symmetric 2% objective. All of these objectives will support achievement of our overarching goal to sustain the expansion with a strong job market and inflation close to our objective for the benefit of the American people. We also decided to conclude the runoff of our securities portfolio in August rather than in September as previously planned. And I'll discuss the thinking behind today's interest rate reduction and then turn to the path forward. As the year began, both the economy and monetary policy were in a good place. The unemployment rate was below 4%, and inflation had been running near our 2% objective for 9 months. Our interest rate target was at the low end of estimates of neutral. Over the first half of the year, the economy grew at a healthy pace, and job gains pushed unemployment to near a half-century low. Wages have been rising, particularly for lower-paying jobs. People who live and work in low- and middle-income communities tell us that many who have struggled to find work are now getting opportunities to add new and better chapters to their lives. This underscores for us the importance of sustaining the expansion so that the strong job market reaches more of those left behind. Through the course of the year, weak global growth, trade policy uncertainty, and muted inflation have prompted the FOMC to adjust its assessment of the appropriate path of interest rates. The committee moved from expecting rate increases this year to a patient stance about any changes, and then to today's action. The median committee participants' assessments of the neutral rate of interest and the longer-run normal rate of unemployment have also declined this year, reinforcing the case for a somewhat lower path for our policy rate. These changes in the anticipated path of interest rates have eased financial conditions and have supported the economy. At our June meeting, many committee participants saw that the case for lowering the federal funds rate had strengthened, but the committee wanted to get a better sense of the overall direction of events. Since then, we've seen both positive and negative developments. Job growth was strong in June, and looking through month-to-month fluctuations, the data point to continued strength. We expect job growth to be slower than last year, but above what we believe is required to hold the unemployment rate steady. GDP growth in the second quarter came in close to expectations. Consumption, supported by rising incomes and high household confidence, is the main engine driving the economy forward. But manufacturing output has declined for 2 consecutive quarters, and business fixed investment fell in the second quarter. Foreign growth has disappointed, particularly in manufacturing and notably in the euro area and China. In response to this weakness, many central banks around the world are increasing policy accommodation or contemplating doing so. After simmering early in the year, trade policy tensions nearly boiled over in May and June, but now appear to have returned to a simmer. Looking through this variability, our business contacts tell us that the ongoing uncertainty is making some companies more cautious about their capital spending. The domestic inflation shortfall has continued. Core inflation, which excludes food and energy prices and is a better gauge of future developments than is total inflation, has run at 1.6% over the past 12 months. We continue to expect that inflation will return over time to 2%. But domestic inflation pressures remain muted, and global disinflationary pressures persist. Wages are rising, but not at a pace that would put much upward pressure on inflation. We're mindful that inflation's return to 2% may be further delayed, and that continued below-target inflation could lead to a worrisome and difficult-to-reverse downward slide in longer-term expectations. So, taking all of that on board, the committee still sees a favorable baseline outlook. Over the year, however, incoming information on global growth, trade policy uncertainty, and muted inflation have led the committee to gradually lower its assessments of the path of policy interest rate that would best support that outlook. Today, we judge that those factors warrant the policy adjustment I described. As the committee contemplates the future path of the target range for the federal funds rate, it will continue to monitor the implications of incoming information for the economic outlook and will act as appropriate to sustain the expansion with a strong labor market and inflation near its symmetric 2% objective. Thank you. I'm happy to take your questions.
Hi, Chair Powell. Gina Smilik with the New York Times. Per your statement here, I guess the question is there any reason to believe that a 25 basis point cut is going to be sufficient to expediently return inflation to your 2% target? And if not, what are you going to be looking at to convince you that you need to cut rates again? What is the hurdle rate there?
So I think you have to look at not just the 25 basis point cut, but look at the committee's actions over the course of the year. As I noted in my opening statement, we started off expecting some rate increases. We moved to a patient setting for a few months, and now we've moved here. And I think what you've seen over the course of the year is as we've moved to a more accommodative policy, the economy has actually performed just about as expected with that gradually increasing support. And I think I wouldn't take credit for all of that, but I do think that increasing policy support has kept the economy on track and kept the outlook favorable. In terms of the rest of your question, the committee is really thinking of this as a way of adjusting policy to a somewhat more accommodative stance to further the 3 objectives that I mentioned, to ensure against downside risks, to provide support to the economy, that those factors are where factors are pushing down on economic growth, and then to support inflation. So we do think it'll serve all of those goals. But again, we're thinking of it as essentially in the nature of a mid-cycle adjustment to policy.
Michael McKee from Bloomberg Television and Radio. There's a perception out there that perhaps in this case the Fed is something of a hammer in search of a nail because the latest consumer spending reports, as you suggested, don't seem to show any kind of demand problem in the U.S. And when you look at mortgage rates, auto lending rates, they've all come down. And so I'm wondering exactly what problem lower capital costs will solve.
So you're absolutely right. The performance of the economy has been reasonably good. The position of the economy is as close to our objectives as it's been in a long time. And the outlook is also good. What we've been monitoring since the beginning of the year is effectively downside risks to that outlook from weakening global growth, and we see that everywhere, weak manufacturing, weak global growth now, particularly in the European Union and China. In addition, we see trade policy developments, which at times have been disruptive and then have been less so, and also inflation running below target. So we see those as threats to what is clearly a favorable outlook, and we see this action as designed to support them and keep that outlook favorable. And frankly, it is a continuation of what we've been doing all year to provide more support against those very same risks.
But the follow-up question is, how does it do that? How does cutting interest rates lower, or how does cutting interest rates keep that going, since the cost of capital doesn't seem to be the issue here?
I really think it does, and I think the evidence of my eyes tells me that our policy does support. It supports confidence. It supports economic activity, household and business confidence, and through channels that we understand. So it will lower borrowing costs. It will work, and I think you see it since we noted our vigilance about the situation in June. You saw financial conditions move up, and you saw, I won't take credit for the whole recovery, but you saw financial conditions move up. You see confidence, which had troughed in June. You saw it move back up. You see economic activity on a healthy basis. It seems to work through confidence channels as well as the mechanical channels that you are talking about.
Heather. Hi, Heather Long from the Washington Post. You always say that the Fed is data dependent, and much of the data that we've seen since the June meeting has surprised to the upside, or at least been in line with expectations. Can you give us a sense of how that better than expected data impacted the FOMC's thinking, and if we keep seeing these upside surprises, does that change or evolve any FOMC thinking going forward?
So yes, I think we, of course, what we do at every meeting, as I noted, is we do a deep dive into U.S. economic activity and global activity, and certainly carefully went through U.S. economic activity, which there's been some positive and some negative, but overall the U.S. economy has shown resilience during the intervening period. But again, the issue is more the downside risks and then the shortfall in inflation, and we're trying to address those. So in addition, going forward, I would say we're going to be monitoring those same things. We'll be monitoring the evolution of trade uncertainty, of global growth, and of low inflation. And we'll also, of course, be watching the performance of the U.S. economy. As I mentioned, it had shown some resilience here to those issues, and we'll be putting all of that together, and that's how we'll be thinking about policy going forward.
CNBC. I just want to follow up on that. Would you say we're sort of, you guys have gotten into a new regime here? This is sort of an insurance cut and not a data-dependent cut? And are we now more in the realm of watching headlines of trade talks than we are watching unemployment rate and inflation numbers and growth numbers? How do we know what you're going to do next and why now in this new regime?
So I gave three reasons for what we did, and that is to insure against downside risks to the outlook from weak global growth and trade tensions. So that is, in a sense, that is a risk management point, and that is a bit of insurance. But we also feel like weak global growth and trade tensions are having an effect on the U.S. economy. You see it now in the second quarter. You see weak investment. You see weak manufacturing. So support demand for it there. And also to support return of inflation at 2%. But there's definitely an insurance aspect of it. Trade is unusual. We don't, the thing is, there isn't a lot of experience in responding to global trade tensions. So it is it's something that we haven't faced before and that we're learning by doing. And it's not exactly the same as watching global growth, where you see growth weakening, you see central banks and governments responding with fiscal policy, and you see growth strengthening, you see a business cycle. With trade tensions, which do seem to be having a significant effect on financial market conditions and on the economy, they evolve in a different way, and we have to follow them. And by the way, I want to be clear here. We play no role whatsoever in assessing or evaluating trade policies, other than as trade policy uncertainty has an effect on the U.S. economy in the short and medium term. We're not in any way criticizing trade policy. That's really not our job.
Nick.
Thank you. Nick Timmeros of the Wall Street Journal. So, Chair Powell, you and your colleagues have offered 3 reasons to cut rates: a lower neutral rate that may have made policy a little bit tighter than anticipated, the global slowdown, the darker risk picture from the trade tensions, and this desire to recenter inflation and inflation expectations. I wonder which of those factors, if any, it weighs most heavily on you. And more importantly, is a quarter-point cut really going to address all of that, let alone any one of those?
So I actually think different people have different weightings, has been my experience on those things. You mentioned lower R-star, trade slowdown, and I would actually add the lower natural rate of unemployment too has moved down. All of which kind of point to more accommodation. So again, I don't think asking about a quarter point is really the right question. I think you have to look back over the course of the year and see the committee moving away from rate increases to a neutral posture to now a rate cut. So I think we've been providing, and that affects the forward rate path, and it affects financial conditions and financial economy. You see an economy which is actually performing pretty well. Growth in the first half of this year is about the same as it was in all of 2018, and actually a little better than our forecast for growth in 2019, at the end of 2019. So I think in a way that's monetary policy working. And again, I wouldn't just look at the 25 basis point cut as the right question.
I could follow up. I guess in May it seemed as if you were setting a higher bar to cut rates. There would need to be a deterioration in the outlook. In June, you seemed to suggest that if the outlook didn't improve, there might be a rate cut. Where is that bar right now? Because I think there's some confusion about how the committee's responding.
Yeah, so we, as we noted at the bottom of the statement that language which really says how we're thinking about it. So it says, as we're contemplating the future path of the target range for the federal funds rate, we'll continue to monitor the implications of incoming information. It talks about that language. So, I can't. All I can tell you is we'll be looking at weak global growth. We'll be looking very carefully to see how that's happening. And I think you learn every cycle. You learn about these things. So we will see whether growth is picking up, whether it's bottoming out. We'll see that picture. We'll also see on trade. We're going to be seeing. I think we've learned a lot on trade in this cycle. I think we'll continue to learn more. And on inflation, we will. So in addition, the U.S. economy itself is the performance of the U.S. economy will enter into that. So I would love to be more precise, but with trade, it is a factor that we have to assess in kind of a new way. Those are the things that we'll be looking at, and in making our decisions going forward.
Edward, and then Ann.
Edward Lawrence with Fox Business Network. So a rate hike last December was seen by some economists and the St. Louis Fed president, James Bullard, as a step too far. Now the Fed's waited about 7 months for a rate cut. You said today you were concerned about downside risks. So could some of the weakness on the business side with that fixed investment and the sluggish side on the business side be because the Fed waited so long? I want to get your thoughts on that and talk about why you feel that this nudge is the right level.
Yeah, so we don't hear that from businesses. They don't come in and say we're not investing because the federal funds rate is too high. I haven't heard that from a business. What you hear is that demand is weak for their products. You see manufacturing being weak all over the world. Business investment is weak, And I wouldn't lay all of that at the door of trade talks. I think there's a global business cycle happening with manufacturing and investment, and that's been, definitely a bigger factor than certainly we expected late last year. I think global growth started to slow down in the middle of last year, but that has gone on to a greater extent. And by the way, trade policy uncertainty has also been, I think, more elevated than we anticipated. In terms of is this the right, we believe this is the right move for today, and we think it will serve the three ends that I mentioned, and I've already gone over how we're thinking about going forward.
Reuters. You called it a mid-cycle adjustment to policy, and I mean, what should we take this to mean, and what message do you mean to send with this move today about future rate moves?
Well, the sense of that is, that refers back to other times when the FOMC has cut rates in the middle of a cycle. I'm contrasting it there with the beginning, for example, the beginning of a lengthy cutting cycle.
So we're not at the beginning of a lengthy
That is not. That's not what we're seeing now. That's not our perspective now or outlook.
Hi there. Are there any circumstances under which you would decide to pause at one interest rate cut, today's interest rate cut, and not go ahead with further monetary easing at this stage, or are you predicting that once you've embarked on this easing, you will have to at least move by one more notch going forward?
So our policy will depend on the implications of incoming data for the economic outlook, as well as evolving risks to that outlook. And so we're going to be monitoring the implications of incoming information for the outlook, as I mentioned. So that's really where I would leave you with that.
Hi, Victoria Guido with Politico. On capital, Vice Chairman Quarles has said that the level of capital requirements that exist right now are such that it's basically like the countercyclical capital buffer is already turned on, and that he would like the ability to be able to turn it down in a downturn. I was wondering if you agreed with that. And then also, just quickly, on real-time payments, larger banks have suggested that if the Fed built its own system, that would be a bait and switch because the Fed asked or called for a private sector system. Do you think that is a fair assessment?
Okay, so on the first, I would say that I view the level of capital requirements and the level of capital in the system as being about right. I do agree with that. The idea that you're talking about is one that's that Vice Chair Quarles has talked about. It's one under consideration. The idea being, in a sense, we've chosen in the United States to have high through-the-cycle capital requirements by doubling the SIFI surcharge, which is the surcharge that the largest banks have in their capital requirements. We've, in effect, already put in place substantial countercyclical buffers. And so conceptually, you can think of I'm not saying it's the same thing as a countercyclical capital buffer. So that's really the point, is that we don't rely, our system doesn't rely on our ability, doesn't mainly rely on our ability to identify the right time in the cycle to trigger a countercyclical tool. We rely on, through the cycle, always on high capital and liquidity requirements. And I think that's a good thing to do. The idea of putting it in place so you can cut it, that's something some other jurisdictions have done, and it's worth considering. I think the United Kingdom in particular has a countercyclical capital buffer that's always on, but that the one point of it is that you can cut when there's a downturn and therefore give the banks more room. So this isn't something we've decided to do. It's just under consideration. In terms of the real-time payment system, your second question, so this is something the United States is far behind other countries in terms of having real-time payments available to the general public. The Fed, really coming out of the reserve system, the reserve banks and the board together convened all of the stakeholders around the table to talk about how we can move forward. This is consumer groups, technology companies, banks, card companies, pretty much all of the groups who would be interested, and worked on a project for several years. And one of the things that came out of that was a recommendation that the Fed should build a 24 by 7 by 365 real-time settlement system to solve that problem, to address that problem. We put out a proposal in October of last year about, should we do this? And we got quite a lot of comments. They were overwhelmingly favorable. And I would point out that in our payment system, in many places, the Fed operates alongside private sector operators, for example, in wholesale payments, in ACH and in check. So it wouldn't be unusual or out of keeping with how we've done things in the past. We have not made a decision on this, but it's something we're looking at carefully and something I do expect we'll make a decision on soon.
Greg Torres from Bloomberg. I'm trying to parse what you're saying here. On the one hand, you say the policy tilt in this statement is ease financial conditions, and that's helping the economy. And that tilt, market participants are interpreting this language will act as appropriate as still being in the statement. And on the other hand, you say it's not the start of an easing cycle. So what are you saying? Does that mean, with one or two more cuts, you'll be done and this policy bias comes out of the statement? Or simply that this policy bias will come out of the statement sooner than market participants think?
So it is, as I mentioned, it's going to depend on the evolving data and the evolving risk picture. But as we look at the situation now and the outlook now, what we see is that it's appropriate to make an adjustment in policy to a somewhat more accommodative stance. That's what we're seeing. And that's what we're going to be looking, we'll be looking at incoming data, at all of the at the risks that I mentioned, and the performance of the U.S. economy at low inflation. We'll be looking at that to make our decisions going forward.
Scott?
Thank you, Mr. Chairman. Scott Horsley for NPR. You've talked a number of times about the people who feel like they are just recently getting to the punch bowl 10 years into this expansion. Can you elaborate a little bit on how this rate cut is expected to help them?
Well, I think the best thing for people who are feeling that, and we are getting lots of feedback from people who work and live in low and moderate income communities to the effect that they're now feeling the recovery, and in fact they haven't felt a better labor market in anybody's memory. So this is great to hear. And I guess my view is the best thing we can do for those people is to sustain the expansion, keep it going, and that's one of the overarching goals of this move and all of our policy moves. There really is no reason why the expansion can't keep going. Inflation is not troublingly high. If you look at the U.S. economy right now, there's no sector that's booming and therefore might bust. You have a fairly well-balanced, in a sense, economy. Now, the engine, though, is really consumer economy, which is 70% of the economy. The manufacturing economy, the investment in manufacturing part of the economy, is more or less not growing much. It's at a healthy level, but not growing much. So, and we hope to help that with this rate cut. But I would say overall, we're trying to sustain the expansion and keep close to our statutory goals, which are maximum employment and stable prices.
Chairman Powell, Donna Borak with CNN. The president has repeatedly called for this rate hike and for the Fed to end the runoff of its balance sheet. What do you say to those that say that the Fed gave in to what the president wanted today? And could you also elaborate a little bit further on why the Fed decided to speed up its balance sheet runoff 2 months earlier today?
So I gave my my reasons for our reasons really for doing this. And just to touch on that again, this action is designed to ensure against downside risks to the outlook from weak global growth and trade tensions, offset the negative effect that those factors are already having, and promote a faster return to inflation of 2%. That's what we've been talking about all year long, and we've gradually moved our policy in the direction of more accommodation. I think what you see is an economy that has reacted well to that. So that's what we're doing, and that's why we're doing it. We never take into account political considerations. There's no place in our discussions for that. We also don't conduct monetary policy in order to prove our independence. We conduct monetary policy in order to move as close as possible to our statutory goals, and that's what we're always going to do. We're always going to use our tools that way, and then at the end we'll live with the results. In terms of the balance sheet, that was really just a matter of simplicity and consistency. Really, nothing more to it than that.
Thank you, Chairman Powell. Greg Robb from MarketWatch. I was wondering, we weren't in the room, but I think it's a fair assumption to know that the two dissenters probably spoke about financial stability concerns. So I was wondering if you could talk about what was your response to them when those concerns were raised. I've collected a couple of things from the IMF and the Bank of International Settlements, said that it's just when you have low rates, you just get more debt in the economy, and that there's also this feeling that it makes it harder to raise rates. So could you talk about that? Thank you.
Yeah, so first let me say, I'll just speak for myself, but I understand those concerns very well. I do. I've studied them, I've spoken about them, and I take them very seriously. But as I look at today's situation, I don't see them as a reason not to take this action today. I just don't think that would be my point. And one of the reasons why I think that is if you look, so we have a financial stability framework now for the first time. Before the crisis, we didn't have this, but now we have it and we publish it, and we look at really four big things so that we know we can, the public can hold us accountable and compare us meeting to meeting and see whether we got this right. So this is transparent now. But the four things we look at are valuation pressures, and we do see notable valuation pressures in some markets, but honestly not at a highly troubling level. In terms of household borrowing, household and business borrowing is the second thing. Households are in a very good shape overall. I'll come back to business borrowing. Leverage in the financial system is low and funding risk is low. So overall, staff's view has been, and my view has been, that if you look overall, financial stability vulnerabilities are moderate. The place that gets all the attention right now, a lot of attention, is business borrowing, and we look very carefully at that. What's happened with business borrowing is the loans have moved off the balance sheets of the banks and into market-based vehicles, which tend to be stably funded. But nonetheless, it's clear that a highly leveraged business sector could act as an amplifier to a downturn. So we're watching that very carefully. But I think if you look overall at the U.S. Financial system, what you see is a high level of resilience, much higher than it was before the crisis. And that's something to take comfort from. And I think all of that gives us the ability to use monetary policy for its purposes and rely on supervisory and regulatory tools to keep the financial system resilient.
So you're not doing something today to help today, and then it's going to cause problems down the road? You're not worried about that kind of dynamic?
There are very few things that I don't worry about at all. So of course we monitor. We have every quarter we have an extensive briefing on financial stability, and we had that yesterday. So we look at this on an ongoing basis. We have a great team. We liaise with central banks around the world. One of my colleagues is the head of the Financial Stability Board globally. So we're very much monitoring these things all the time, and we worry about them all the time. We're always looking for that thing that we may have missed a lot of the time. But the things we haven't missed, I think they paint a mixed picture, but not one that should prevent us from taking monetary policy actions that we think are appropriate to support the economy.
Marty and Dawn.
Marty Krutzinger, AP. You've talked in this press conference about being data dependent going forward, and that this is not the start of a series of rate cuts. But the financial markets seem to think that this is the start of a series of rate cuts, and they're predicting 3-4 cuts this year. Is this your effort to try to damp down that thinking?
No, let me be clear. What I said was it's not the beginning of a long series of rate cuts. I didn't say it's just one or anything like that. What I said is when you think about rate cutting cycles, they go on for a long time, and the committee's not seeing that, not seeing us in that place. You would do that if you saw real economic weakness and you thought that the federal funds rate needed to be cut a lot. That's not what we're seeing. What we're seeing is that it's appropriate to adjust policy to a somewhat more accommodative stance over time, and that's how we're looking at it. What I said was it's not a long cutting cycle. In other words, referring to what we do when there's a recession or a very severe downturn. That's really what I was ruling out. I think if you look back at other mid-cycle adjustments, you'll see, I don't know that they'll be in the end comparable or not, but you'll see examples of these.
It's Don Lee with the LA Times. You mentioned the difficulty of assessing trade tensions in the economic outlook. And could you say how much of a factor the U.S.-China trade conflict was in the Fed's decision to cut rates? And if the current stalemate and the threat of more tariffs continue, what would that mean for future interest rates and possible cuts?
So I wouldn't bring it down to any one trade thing or any one factor. I think we look at a broad range of factors, and trade uncertainty, trade policy uncertainty is one of them. That certainly includes the discussions with China. But I wouldn't be able to tell you how much of it is due to that. And without knowing, I think we with trade we have to react to the developments, and we don't know what they'll be, and so it's hard to exactly say. It's certainly. We've seen, though, that when there's a sharp confrontation between two large economies, you can see effects on business confidence pretty quickly and on financial markets pretty quickly. We saw that in June. But then we saw them unwind after that to some extent. You've seen it returning to a much lower temperature, I think. Again, with trade policy, we're just going to be watching and trying to assess the implications for the U.S. outlook. The mechanical effects of the tariffs are quite small. They're not large as it relates to the U.S. economy. The real question is, what are the effects on the economy through the confidence channel, business confidence channel? And again, very, very hard to tease that out. I've seen some research which says that they are meaningful effects on output. As to say, not trivial. And I think that sounds right, but it's quite hard to get it. There is no way to get an accurate measure. You have to look at a range of estimates, and I think businesses will tell you that it's a factor, particularly manufacturing businesses that have supply chains that cross international borders will all tell you that it's been a challenge. Many of them have made adjustments, and they've gotten to a place where it's okay, but it's been a challenge.
Okay, Paul, and then John.
Paul Kiernan from Dow Jones Newswires. Thanks for the question, Chairman. As the press conference, as this press conference has gone underway, markets have declined. The Dow's down as much as 400 points. What I'm hearing is a reluctance to provide more guidance around the future path of rates. And I'm wondering if that reflects a greater lack of consensus on the committee, and how much consensus do you want to see around these decisions, and how split are people about this?
You're right. There's a range of views on the committee, but the committee is unified, completely unified, on our dedication to making the best policy decisions we can make, and that means people have a responsibility to do their best thinking and present that thinking, and I wouldn't have it any other way. In terms of the way forward, we will be monitoring the factors that I mentioned, and we lay that out in the in the post-meeting statement, and that's the roadmap we're going to be following going forward. We're going to be data dependent. We're going to be, as we always are, doing what we need to do, what we believe we need to do to support the economic expansion.
John Heltman and then Nancy.
Hi, John Heltman with American Banker. So it's been about 18 months since the Fed issued its enforcement action against Wells Fargo. And I was wondering if you could characterize the progress that the bank has made towards the shortcomings that it had in its risk management processes. And I'm also curious whether their lack of a permanent CEO has hampered progress in your eyes.
So the problems at Wells Fargo, that arose at Wells Fargo, around risk management and consumer, the way they dealt with the consumer were actually pretty deep. And I think the company realizes that, and they're not going to be fixed. They haven't been fixed quickly, and frankly, we didn't expect them to be fixed quickly. So they will be under the growth cap, our enforcement action, until the board votes to lift it, and that's not something we're considering doing right now. And the company is working away to address these issues. But as I said, they're deep-seated issues, and it just takes time to address them. I wouldn't comment on the CEO question. I don't really have anything for you on that.
Are you pleased with the responsiveness you're getting from them? Do you feel like this is going the way that you kind of want it to go?
I'm not going to characterize it. I have characterized it. We have an enforcement action in place. The company's working away at addressing it. They take it seriously. I think they do see it as we do, as something that has to go deep, and we'll lift the growth cap when we're satisfied.
With Marketplace. So when we have our next recession, the Fed will have less room. It will happen. The Fed will have less room to maneuver cutting interest rates since you're cutting now. How big of a problem will that be?
The premise is not. I'll question your premise for a second. If you remember, one of the purposes of our cut today is to support the expansion, and we don't know when. And if it really works, if that works very well, and the economy gets going again, you don't know where the funds in other cycles, and I don't know whether this will happen or not. But in other cycles, the Fed wound up raising rates again after a mid-cycle adjustment. Again, I'm not predicting that, but I don't think that we know that we'll have less ammo because of these things. That's one thing.
You won't be able to cut as much if rates are low. I mean, you will have less ammo in that sense.
Well, but you're assuming that we would never raise rates again. That once we've cut these rates, they can never go back up again. As a matter of principle, I don't think that's right. In other long cycles, long U.S. business cycles have sometimes involved this kind of event where the Fed will stop hiking, in fact, will cut, and then we'll go back to hiking. Again, I don't know whether that'll happen here. It doesn't seem like something that's in particularly likely, frankly, but we don't know that. And the other thing is, I think by extending the cycle, you do have a lot of benefits from that, and I think we will use the tools that we have. A couple of rate hikes one way or the other isn't going to matter so much. If there is a downturn, you're right, there will eventually be one. We'll use all of our tools aggressively as we need to when that time comes.
Jean? And then Courtney. Hi, Jean Young with M&I. Can you give us an update on the ongoing reassessment of the inflation framework, and have the discussions so far this year had any bearing on today's decision?
So the monetary policy review is really it's really there to look at the way we make policy in the longer run, and it's not something that enters directly into our discussions today. We've had a series of meetings called Fed Listens at almost all the reserve banks. Soon it will be all the reserve banks. And we meet there with the constituencies that we serve, and they've been very, very successful. Hearing from people, not just economists, but people who are not economists, how their lives interact with the Fed's work. It's been great. I got to say, it's been even better than I hoped it would be. We're just now beginning the process of incorporating all of that feedback, and we're going to be having a series of meetings beginning today and yesterday, as we evaluate the questions that we're asking about our framework. So it's very early to say where that's going, but we're setting the table now and looking at what our framework is and looking at how it's performed, looking at how all frameworks performed around the world during the global financial crisis. I expect we'll be at this a while. I'm very excited about it. I think it's been a good exercise. I think it's opened us up to to sunlight and perspectives that we might not have gotten otherwise. And I think it's a good time. You have 10 years after the crisis, you're really living in a new normal for the economy and monetary policy, and it's a really good time to step back and ask whether there are some things that we can do to improve our framework.
Courtney and then Brian for the last one. Hi, Mr. Chairman. Courtney Brown from Axios. Can you give us a sense of whether the committee feels constrained at all by the market's expectations for more cuts or other developments in financial markets?
So I think this was well telegraphed. What we did today was very consistent with what we had said we were going to do. I mentioned the reasons for it. They've been well telegraphed, and I think I think they will achieve their goals. We do know that monetary policy works through communications and then actions that are consistent with those communications, and we think that the changes that we've made this year have really worked. Of course, we always retain the flexibility to adjust our communications and our actions in light of incoming data and the evolving risk picture. But I'll leave it there.
Brian Chung with Yahoo Finance. Just to expand on that point about communication, I mean, we saw that markets have been particularly sensitive with regards to New York Fed President John Williams' remarks before the blackout period. So the Fed added language in the statement that says that the committee is contemplating the future path of target range for the federal funds rate as it monitors implications. I'm wondering now there's kind of this inflection point about whether or not the downside risk, because you've had to cut rates, outweighs the fact that you still see a positive outlook of the U.S. economy at a baseline. So just wondering if you can kind of clarify all of those things within the context of the challenges of communicating it.
Yeah, I see the U.S. outlook as being a positive one. And we have had these global, really, risks to the outlook. There really is nothing in the U.S. economy that presents a prominent near-term threat to the U.S. economy. As I mentioned, there's no segment that's really, or sector that's really boiling over and overheating. Nothing like that. It's within the economy. It's healthy. So I would say that downside risks are really coming from abroad, and of course we are concerned about low inflation. But by the way, those risks from abroad are affecting the manufacturing sector here and business investment, fixed investment. So.
Okay. Thank you very much.
Thank you.